And joining us today to talk about Bitcoin's moves are two individuals with a great deal of experience in options and futures markets. Josh Lim is head of derivatives at Genesis Global Trading. Welcome, Josh.
Great to be here.
And I should note that Genesis is owned by Digital Currency Group, which is CoinDesk's parent company. Also with us is Luuk Strijers, Chief Commercial Officer at Deribit. Welcome, Luuk.
Thank you. I'm glad to be in your home.
Yes, it's very comfortable here. Josh, let's start with you. Volatility at the monthly Bitcoin options expiry has been a noted pattern this year. Whether they are in the spot or derivatives markets, how should investors approach this trade?
Yeah, so I think this is one thing that we've really highlighted in some of our commentaries over the past couple of months. But the effect is particularly pronounced like earlier this year. It's a combination of the fact that expiration is the last Friday of the month, which means that it's sort of closely entwined with inflows and outflows from hedge funds that are looking to allocate into crypto. So I think a big part of what we're seeing, especially around these expirations, are dynamics around one thing that you mentioned earlier, the sort of short gamma positions or concentrated sort of risk positions that dealers have, but also the sort of net inflows and outflows from crypto hedge funds. And of course, like what we've seen, at least at the start of the year, was a lot of allocation in. And so you had this sort of dynamic that would result in strong moves post expiry, coming out into the first of the month.
Luuk, we've got a chart here that you provided showing open interest by strike point on Deribit for the August 27 contract. The red line there in the middle, there it is, showing the max pain point where the fewest contract buyers get paid. Has Deribit seen evidence of changes in the way participants are trading on the monthly cycle?
I think over time, yes. In this particular one, not really. So August is, as your previous chart showed, is smaller than September and December.
Indeed.
So it's not a quarterly expiry. So overall focus on this one is slightly less than the quarterlies. However, still it's an important moment. As you see in this one, it's a narrower focus of the previous chart. So you showed like 42,000 total contracts outstanding. This shows approximately 37,000. So that's around 90% on Deribit out of total 42. As you can see here, there's a lot of calls expiring out of the money. So the right-hand side of this chart, so that's like upside potential, which the market hasn't reached. Max pain levels of 44,000. I think the most important thing to focus on this chart is the 50K strike. So if it gets within range, you might see some additional volatility, some movement pressure towards this strike, which could act a bit like a magnet.
Is there concern about market manipulation here, or are we just seeing the kind of monthly flow?
It's normal. So this happens all the time. So there's people that are bullish, bearish, different trading styles, market makers, takers. This is normal. This happens in equity options and in index options, in essentially every product that has open interest. So this is normal behavior.
Josh, let's move from options to futures for a moment. The Bitcoin futures markets have had a turn in the sun recently, with SEC Chairman Gary Gensler noting his preference for a Bitcoin ETF based on the regulated Bitcoin futures market run by the Chicago Mercantile Exchange. What's the interplay between spot and futures, and is one more resistant than the other to manipulation?
Yeah, sure. So the CME has constructed a pretty robust methodology for cash settlement on their futures contract, which is, a sampling and an average of multiple exchanges across the world in the spot space. So, it is something that we trade pretty often. It is not that difficult to replicate and to hedge to. So, it is in that sense like a true tradable sort of cash fixing. I think the one thing that is even more important than sort of the settlement value is, thinking about how these sort of contracts are collateralized, and the fact that they are cash collateralized contracts, meaning you have to post US dollars to hedge or to collateralize your both long and short positions on Bitcoin futures. So to the extent that this sort of ETF creates more of a demand dynamic for these futures, The real question is, does that put sort of pressure on the dealers that are on the sell side of that equation? And does it create sort of more demand for cash in the crypto ecosystem?
What do you think might be the outcome of that if we do get to a point where we have an ETF product based on the futures market? It seems like you could be pointing to some potential implications there in the futures market as a result.
Yeah, I think the thing that we hear a lot from traders that we talk to is there's an expectation that the CME futures curve, which currently is below the premium on other futures markets, like for instance on Deribit, that whole curve is trading below at a level sort of reflecting the fact that there's currently a lot of sellers of that contract. If there were to be more buyers of that contract, you would expect that curve to shift higher and maybe trade more in line with some of the offshore exchanges.
Let's talk about the CME market specifically. It grew dramatically last year in Bitcoin terms. In open interest, it's declined in 2021. What do you make of that? Is there anything to make of that? Do you think it's a reliable indicator of institutional interest in Bitcoin and the bull or bear positions that investors are taking?
I think that,
Go ahead.
Yeah, so I would say, I'll quickly say, I think there's, there is growth in the usage of the CME contract. I think Deribit's obviously still sort of the gorilla in the room when it comes to crypto native market participants, but the fact that we're seeing more sort of block trading activity, we're seeing sort of people use the futures as a way to, for instance, like hedge their, ETF sort of market making capabilities, things like that. We're seeing a lot of institutional guys come in and use these products in a new way. And I think that's only going to continue to grow. I mean, even now, you're seeing like $2.5 billion of volume per day on CME futures contract. And that's pretty encouraging to see that much activity.
Luuk, let's look outside the U.S. for a moment. You're based in Panama, and despite the growth of the CME, offshore operators like you still make up the majority of the volume in derivatives markets. What is happening offshore, and what should regulators in the U.S. and other major financial centers think about it?
I think not every market is the same, and that's for one. So if you look at us versus FTX, Binance, etc., I think you will see a clear distinction in our focus versus the others. We have a significant options focus, which means that everything we do targets options, features, services, etc., our development efforts, which results in, of course, the market share and options, but also a different setup in our future space. So if you look at open interest in futures specifically, besides CME, you will see that we are number one with a bigger open interest position versus the other offshore platforms. This is simply a consequence of our institutional base. So if you look at institutional traders, typically any new macro investor, they enter the space by buying spot, and step two would be more capital efficiency. So they buy futures on CME or on Deribit. So that's what you typically see, or options, for example. So our open interest base is like the inverse of Binance, where they have a massive retail base, resulting in a lot of perpetual exposure. So they have something like 10 billion or something overall in open interest. If you look at our open interest, it's dominated by options, of course. It's 12 billion in options and 4 billion in futures, which makes the let's say the trading base totally different. So what's happening? I think any platform would tell you the same. We see a lot of inflow in clients, a lot of new clients entering from the traditional space, which has been said for months and months. But the biggest difference now is that instead of the smaller firms, trading entities, HFTs, etc., what you see now is also the buy and hold investors. So a lot of funds, asset managers, private banks, etc., all entering the space, which is rather unique. So even though the market peaked in May, trading-wise, open interest-wise, price-wise, we see a lot of inflow still in onboarding. And especially those larger funds, they take much longer time to actually get started. So where a retail trader can start in minutes, a traditional fund like that would take a few months, perhaps even.
Luuk, you mentioned the perpetual swap, and I think over the past year or less, we've seen a significant fragmenting in the kind of retail-focused offshore market for those kinds of instruments. BitMEX, to some extent, dethroned as the dominant operator there, for example, and upstarts like FTX or even Binance Futures taking market share. What do you make of that? What's the where is that market headed, and any sense of kind of what's been happening among the different platforms that are operating in derivatives?
I think what you see is a clear distinction in markets focus. So what you saw in the past was everyone was competing for the same. What you see now is that some markets focus on spot, some other focus on options like us, our institutional investors, versus retail in general. There's differences in regulatory approach, like BitMEX, like Binance are getting licenses all across the world. So everyone's focus, instead of competing, has become a different value add, which is kind of interesting to see. I think overall what you see is that there's a distinction between retail-focused platforms versus institutional. As mentioned before, you can see it in the different products traded, options and futures versus perpetuals. You also see that the retail-focused platforms have decreased leverage. So the 100x has become 20x or something comparable. That's a trend. I don't think it has any impact, a real impact on the market. So not a lot of people actually use this, but stuff like this is happening as a response, I think, to regulatory questions.
Yeah, well, that's an interesting question. I mean, I do think you see certainly some of the operators getting closer to what regulators might expect to see. Josh, I'm curious your perspective on this. Do you think there's some halfway point? Will you see regulations start to change, established markets start to change, and maybe even adopt some of the innovations that have emerged in the offshore markets? Or is most of the shift going to go the other way, with the offshore and lightly regulated operators starting to toe the line with the existing regimes?
Yeah, I think our view as a firm is there's always going to be these two worlds, which I think for the most part will stay separate, right? This sort of offshore world where crypto native market participants are happy to sort of participate in, and I think more and more that's going to blend in with more DeFi sort of trading platforms, DeFi derivatives, DeFi perpetuals, DeFi options, and then conversely, kind of on the other side, there's the institutional world that is coming from traditional finance, and those guys are going to gravitate towards the CME platforms that I think that's more like a winner take all type of situation, where you have kind of one dominant exchange where all the liquidity is, and I think that's kind of, you're already seeing those things happen now, but we think there's going to be increased focus on regulating the major sort of the major regulated venues, the sort of ones that institutions are moving the most size in. And then on the offshore venues, I think Luuk can kind of speak to this a little bit more, but oftentimes there's a question about jurisdiction and if these platforms sort of de-platform US customers and other sort of market participants that would be under those regulated regimes, maybe that sort of frees them up to do release more interesting products and things like that. I think you're sort of seeing some things like that happen when you have platforms like BitMEX, emerging from a difficult situation, but now adding like a swath of new products, new perpetual swaps, things like that. As they sort of shed some customer base from the past, they're able to sort of get more flexibility going forward.